Good morning, everyone, and thank you for joining us today. To understand the investment landscape in South Korea, we must first unlearn a fundamental assumption of Western corporate finance, the principle of value convergence. In Western markets, companies like Alphabet or Apple operate under a unified structure. When you buy Alphabet, you automatically capture the intrinsic value of Google, YouTube, and its emerging tech units. Core assets remain private subsidiaries, meaning all performance flows directly into a single ticker. In South Korea, however, we face a segmented value reality. If you look at the Samsung ecosystem, buying Samsung is not a single transaction. Instead, you are forced to navigate a fragmented labyrinth of dozens of separately listed entities, ranging from electronics and batteries to biologics and finance. Core growth engines are systematically carved out and listed independently. For global investors, this raises a critical dilemma. Which asset truly captures the underlying growth, and how do we avoid the severe dilution of parent company shareholder value? This structural paradox is the foundational pillar of the Korea discount. Moving on to slide 2, let's look at how this paradox manifests visually. To invest effectively in Korea, analyzing standalone financial statements is simply not enough. We must dissect the intricate ownership networks orchestrated by controlling families. Take a look at this network map of the Samsung Group. What you see is a complex web of circular and pyramidal shareholdings. Notice the top-tier anchors, entities like Samsung C&T and Samsung Life Insurance. These are not just operating businesses. They serve as the structural pillars ensuring familial control over the entire empire with minimal capital exposure. Right in the middle sits the crown jewel, Samsung Electronics. It is controlled via minority stakes held by these top-tier affiliates, yet it simultaneously acts as a holding entity for other listed subsidiaries down the line. This multi-layered architecture creates a massive dispersion of value. Unlike Western conglomerates, where incentives are aligned at the top, this structure creates systemic vulnerabilities to intercompany conflicts of interest, often leaving minority shareholders at a structural disadvantage. To capitalize on the changes ahead, we must understand how Korea became a listed affiliate department store in the first place. This model was born out of historical necessity during the nation's rapid economic development from the 1960s through the 1980s. During this era of capital scarcity, state-directed finance channeled limited national resources into a select few family-led conglomerates known as chaebols. Because domestic banks lacked the deep capital pools required to fund massive industrial expansion in heavy chemicals, shipbuilding, and tech, the equity markets became the primary funding vehicle. Chaebols bypassed strict debt limits by utilizing serial initial public offerings. Every time a group wanted to fund a new venture, they spun it off and raised capital directly from the public. Crucially, this allowed controlling families to absorb massive waves of external capital without diluting their supreme voting power over the group. For decades, this was viewed as a feature of high growth. Today, it is recognized as a legacy governance risk. As you can see here on slide 2, this duplicated, multi-listed structure is not an anomaly isolated to Samsung. It is the standard operating blueprint across the entire Korean market. Look at the data. SK Group features SK Inc. as the holding company, but its underlying value is heavily split across multi-billion-dollar listed entities like SK Hynix, SK Innovation, and SK Telecom. HD Hyundai exhibits the same pattern, listing its shipbuilding and marine solution arms separately. Even Kakao, a modern internet platform company that grew rapidly over the last decade, aggressively replicated this legacy chaebol playbook by listing its banking, payment, and gaming units as independent entities. For global asset managers, this widespread duplication triggers severe double counting traps, where the market value of the sub-entities is drastically discounted at the parent level. This misalignment of incentives has led to severe friction between controlling insiders and global minority shareholders, culminating in what the market calls split-off trauma. Let's look at 3 recent cases that brought this issue to a boiling point. First, the LG Chem and LG Energy Solution case. LG Chem was highly sought after by global funds for its EV battery business. However, management carved out the battery unit into a newly listed entity, LG Energy Solution. Existing parent shareholders were left holding a hollowed-out company, triggering a massive holding company discount and wiping out billions in market cap overnight. Second, HD Hyundai Group. Following the 2021 IPO of its heavy industries arm, the group listed HD Hyundai Marine Solution, triggering severe stock volatility due to valuation double counting. The backlash from institutional investors was so fierce that it successfully halted the planned IPO of HD Hyundai Robotics. Finally, Kakao Group fragmented a single cohesive platform ecosystem into separate listings, destroying the parent company's growth momentum. This invited aggressive regulatory scrutiny and effectively blocked future spinoffs like Kakao Mobility. These events have proven that the status quo is no longer sustainable. This brings us to the core of our investment thesis, the 2026 regulatory paradigm shift. Following decades of relentless pushback from global hedge funds and institutional investors, the South Korean government has initiated a sweeping structural intervention through the Capital Market Structural Improvement Plan. First, the Korea Exchange has established strict IPO gatekeeping. The regulatory stance on concurrent parent subsidiary listings has officially shifted to banned in principle and allowed only under exceptional circumstances. The era of unchecked choge기 상장, or opportunistic split-offs, is effectively over. Second, regulators have mandated explicit shareholder compensation mechanisms. Any approved carve-out now requires concrete measures to protect parent shareholders, such as distributing shares of the new subsidiary as in-kind dividends or executing massive treasury stock cancellations to boost earnings per share. Furthermore, advanced protections are currently under active review, most notably the majority of minority, or MOM rule. If implemented, this will grant non-controlling public shareholders an absolute veto power over major corporate restructurings, aligning Korea with global governance standards. To conclude, how should global institutional investors navigate this transition to capture alpha? First, we must mandate comprehensive governance mapping over pure financial statement analysis. Standalone financial metrics are deceptive in Korea. Your valuation models must explicitly integrate the entire group's ownership map, the scale of internal transfer pricing, and the risk of value leakage. Second, and most importantly, we need to capitalize on this structural re-rating opportunity. The regulatory overhaul, combined with the ongoing corporate value-up program, is fundamentally changing the capital allocation incentives for chaebol managements. Historically discounted holding companies can no longer hoard cash or split off assets. They are now legally and structurally incentivized to deploy capital toward treasury share cancellations and enhanced dividend payouts. The structural discount that has plagued Korean equities for 50 years is dismantling. Investors who correctly identify the mispriced holding companies positioned for this governance re-rating stand to capture significant upside. Thank you, and I am now open to your questions.